everyone. Welcome once again to the Chartered Accountants Academy video lectures. My name is Davidzo Paradzai, and in this video lecture, we continue with evaluation and concluding. That is to say, evaluation of misstatements is found in ISA 450. What are the important ISA 450 principles? Do you understand what a misstatement is? When we say financial statements are not materially presented or they are materially misstated, this is when the auditor does not agree with what is reported in the client's financials, right? It could be due to an amount, classification, presentation, or disclosure of financial information which has not been done in accordance with an applicable financial reporting framework, right? Maybe their trade receivables are materially misstated. Maybe they are not presented in accordance with IFRS 9, right? So the financials will be materially misstated. What should an auditor do with identified misstatements? To whom does the auditor report about this materially misstated information, right? Do they evaluate the information, the significance of the information? Will it affect their report? Will it impact on their opinion, right? Then there's a term called clearly trivial. When they are performing their evaluation and concluding, their figures which, if they are misstated, the auditor would not worry much about those figures, right? So the auditor has to determine an amount which they will call clearly trivial, right? To whom does the auditor communicate the misstatements? Do they tell management? How does management respond? And how will the auditor conclude? So there are steps in evaluating and identified uncorrected misstatements that the auditor should follow. That is, they should state the given materiality. You will remember during the year we went through materiality. The auditor calculates materiality for a particular client. Then against that materiality figure is when they will use as a benchmark to say are the financials materially misstated or they are not materially misstated, right? During their performance audit of audit procedures, they identify what possible misstatements, that is misstatements on the trade receivables, misstatements on assets, misstatements on inventory, any other line item. So is the line item materially misstated against what? The set materiality. Then the auditor will have to accumulate this identified misstatement so that he can determine in aggregate are the financials materially misstated given the line items that the auditor saw. If combined, will they exceed the materiality figure? Will this affect the audit opinion? What will happen to the audit report, right? So the auditor also has to determine and document an amount below which misstatements would be clearly trivial and remove this from the accumulated misstatements. That figure which we said it's clearly trivial, it's small, the auditor is not going to worry about. It will be removed from the what? From the accumulated misstatements so that they remain with material misstatements and identify the impact on the financial, on the auditor's report. The auditor will have to determine whether each of the individual misstatements is quantitatively material, that is, against the materiality figure. Is this figure material? This misstatement is found in inventory. This misstatement is found in revenue. Is it material? That is, they have to determine whether it is a factual misstatement, judgmental misstatement, or projected misstatement. Factual to say there is no doubt inventory is materially misstated, maybe because it's not recognized at the law of cost and NRV. Judgmental, using the auditor's judgment, they are saying the financials, this line item is materially misstated. Projected misstatement, they have used a sample to as an audit procedure, right? Then if I project the information, the results that I have found, will they amount to the majority of the information given? In a projection, will I say these financials are materially misstated based on a what? On a sample. So quantitatively material, that is the dollar value quantitatively, right? And it has to be distinguished between factual, judgmental, and projected. Then the auditor now has to say and discuss whether the misstatements are quantitatively material in aggregate, right? After adding all the misstatements against the materiality figure, are they quantitatively material? Are they quantitatively misstated, right? So the auditor will then now need to draw a table showing the aggregate effect on the misstatements and to compare those misstatements to the materiality figure. That is a table to show current and non-current assets, the impact of the transactions. We are saying inventory is materially misstated. Inventory is shown under what? Under current assets, right? Current and non-current liabilities, is there any impact? Net profit before tax, is there any impact? So in a test or exam, you can actually be asked to draw this table to show the impact. If you do practice questions, if you read through your module, you'll continue to understand this concept. But for every misstatement, you need to identify which line item is being affected. Then in aggregate, am my financials materially misstated? Now, the auditor also has to determine whether the misstatements are qualitatively material. This is to say, when financial statements have got non-compliance with legislation, non-compliance with IFRS, misstatements that undermine key ratios, misstatements due to fraud by management, right? This would be considered as qualitatively. We cannot attach a figure to it, but qualitatively, overall, non-compliance with tax laws, non-compliance with the RBZ laws, right, is non-compliance with legislation, non-compliance with IFRS, maybe impairment, carrying amount is greater than recoverable amount. There's been a mistake in calculating carrying amount, recoverable amount, then they are non-compliant with IFRS, or they know the exact treatment, but they have chosen to do the wrong thing. That would be non-compliant with IFRS principles and considered as qualitatively material, which will have an impact on the what? On the financials and also on the audit report. So, after the misstatement has been identified, the impact on the audit report, the impact on the audit opinion has to be determined by the auditor. So we are saying, nature of matter giving rise to modification, right? What is the auditor's judgment about the pervasiveness of the effects of possible effects on the financial statements? We are saying our financial statements, are they materially misstated? And also that information which has made them materially misstated, is it pervasive, right? Alternatively, they could be both material and pervasive. Pervasive is to say this issue, looking at integrity of management being questionable, I cannot attach only one account balance that has been affected. If they have questionable integrity, chances are the financial statements as a whole will be materially misstated, right? So you go down to your table. You'll also find this table in the what? In the standards, and you need to flag it so that you make the correct assessment in a test or exam. We are saying financial statements are materially misstated, right? But this misstatement in the financial statements is material, although it's not pervasive. So I will express a qualified opinion. Agreed? The financial statements are materially misstated. This misstatement is material and pervasive. I will express an adverse opinion. Make sure you go through your module, have a further understanding of these terms so that when you go through the steps, you will express the correct opinion. The auditor was unable to obtain sufficient appropriate audit evidence. Maybe management is hiding something and they did not give them enough information. They say to management, you cannot access our inventory records, you cannot access our payroll for reasons known to them, right? The auditor was unable to obtain sufficient appropriate audit evidence, therefore posed with a limitation of scope. The limitation of scope is material, however, not pervasive. Express a qualified opinion. Then, the limitation of scope is material and pervasive. First of all, it's material. The amount will affect the user's understanding of financial statements, right? And also, we believe this information which is missing does not only affect one line item, therefore express a disclaimer. So make sure you clearly understand what an adverse opinion is, what a disclaimer of an opinion is. When do I express a qualified opinion? Due to material misstatement or limitation of scope. This table is very important. It will be the conclusion in your steps of expressing an opinion on financial statements. Then also, the auditor can write. Then also moving to written representations. You remember we've always said obtain a signed and dated management representation letter. How do these written representations come through as found in ISA 580? We are saying, from whom should a representation be obtained as guided by ISA 580, paragraph 9 and A2 and A2, A6, right? Well, there are times when there will be required mandatory representations. The period should be stated, the date of the representation. The form of representation has to be in writing. Management's integrity. What is the process followed when ethics are in doubt, representations are refused, right? So, with regards to management representations, it is found in ISA 580. So, what have been the common pitfalls? Discuss the accounting treatment that should be made by DHL in respect of transactions detailed under the headings Other Events. What could happen? So these are common pitfalls covering evaluating and concluding part 1, then also part 2. Some students would just dump theory of accounting standards, giving definitions without application to the scenario. That is leaning towards answering in terms of IS 37, forgetting that even in audit there is subsequent events that they had to address. Some students seemed not to understand the required. Most of the time was spent on explaining the definition of the provision, yet the question wanted more on adjusting events. So make sure you understand the required and what is being asked of you. Some students failed to maximize on breaking down each event and reference point that indicated the event before or after year end, the post-balance sheet event, evidence of considerations that existed at year end, failed to also break down factors for the contingent asset and generalize the solution. If you go through the scenario on DHL, it will be given to you as a practice question. You will understand the breakdown that is required so that you don't lump your suggested solution and you gain marks as you create your solution. Then there was another required to say, other events with reference to Matter 1 provide a discussion of the auditor's responsibilities and provide examples of procedures that should be performed. What was required? A discussion of the auditor's responsibility and providing examples of procedures that should be performed. What happened? Generally, students did not perform well on this question. Some did not even attempt the question. Students went on to provide general procedures regarding the identification of subsequent events without explaining the specific auditor's requirement pertaining to the matter. You are given another event. What happened, right? What is the auditor's responsibility at that particular time? Has the audit report been published yet? Have they expressed the opinion yet? What is the responsibility of the auditor at that particular time? Referring to metaphor, provide a discussion of the auditor's responsibilities and provide examples of procedures that should be performed had the matter come to light after signing of the auditor's report. What was expected of the students? A discussion of the auditor's responsibilities and providing examples of procedures to be performed had the matter come to light after signing of the auditor's report. Some students answered the question by giving general subsequent events procedures. Others linked the part 2 to part E. I'm sure it will make sense after going through the scenario and attempting the required. And take note, it was said, had the matter come to light after signing of the auditor's report, how do they respond? Make sure you pay attention to the detail given. This brings us to the end of this video lecture. I hope you found this useful. Thank you.